This is absolutely a global issue, and that's why it's critical that you get in position today, because I don't know the exact moment that we're going to lose choice, but I know that it's close. I know that insanity can last longer than you would think, but it can't last forever. Food, water, energy, security, barterability, wealth preservation, community, and shelter. These are the things that we all need to sustain our standard of living. And if you have physical gold, you're going to be in a position to take advantage of the inevitable. That's what history tells us. And let me tell you, if it's happened over 4,800 times and we're doing the same thing, the best shot is that we're going to get the same result. How many layers of debt can you add with the same underlying asset? And the more layers of debt you have, the riskier everything is. So bank profits have been strong this year and capital ratios remain well in excess of regulatory requirements. That's just about keeping you comfortable. Some challenging conditions remain due to compressed net interest margins. Yeah, with interest rates as low and the bank's lending has actually been flat or negative, they aren't making as much money through loans. Leverage at broker-dealers was low. Leverage continued to be high by historical standards at life insurance companies, which was a question that was asked on Wednesday's Q&A. And hedge fund leverage remains somewhat above its historical average. Issuance of collateralized loan obligations, CLO, and asset-backed securities, ABS, has been robust. Now, both CLOs, it was the CDOs that took the system down in 2008. So the difference between a CDO and a CLO is that one is based upon on mortgages, mortgage debt, and this is based upon loan debt, which can be actually what's behind it. And remember, a CLO and ABS, these are all derivative contracts. So you cannot, and a derivative is just a big leveraged debt, layer upon layer of debt for the same asset. That makes it extraordinarily risky. Liquidity risks at life insurers remain at post-2008 highs and have been increasing. Over the past decade, the gap between the liquidity of assets, so the ability to sell it quickly, and liabilities of life insurers has increased, potentially making it harder for life insurers to meet sudden withdrawals of their deposit-like liabilities, so those guarantees. On the asset side, life insurers' share of liquid assets on their balance sheet has decreased, reaching historically low levels. In addition, life insurers' exposure to risky and illiquid assets, including CLOs, has increased, in part in response to how long-term interest rates on the liability side, life insurers have increased their reliance on non-traditional liabilities, and that doesn't really matter. It's all of these derivatives because they are reaching for yield. So when somebody, like the question was, well, I'm guaranteed 6%, but the market is below that, right? So what does that mean? That means that they are taking on a lot more risk to generate those guaranteed returns. And if they can't sell, if there's a lot of people that make a demand and they cannot sell the assets to pay those liabilities fast enough, you're not going to get your money. It really is that simple. Okay. On the liability side, these liabilities are more vulnerable to rapid withdrawals than most policyholder liabilities. So if they go away, there's nothing you can do. And you can see the growth in less liquid assets held by U.S. insurers. And this is the list of it, but it doesn't really matter. So if you go in and you want your money, you may have a hard time getting that out. And then lastly, the funding risk. Domestic banks relied only modestly on short-term wholesale funding and continued to maintain sizable holdings of high-quality liquid assets. By contrast, structural vulnerabilities persist in some types of money market funds and other cash management vehicles, as well as in bond and bank loan mutual funds. There are also funding risk vulnerabilities in the growing stablecoin sector, which we're not going to talk about stablecoins in here. I'm just going to keep to this. But total runnable money-like liabilities is over $18.227 trillion. And uninsured deposits have gone from an annual growth, because of all of this new money sloshing around the system, from 12% to almost 19%. At the same time, money market funds, so people taking money out of the money markets and gone into the stock markets, what's that, out of the frying pan and into the fire? So those have actually declined quite substantially from a growth level percent of 5.9% a year to a minus 2.2. They're talking about money market reforms, just like in 2008. Money markets froze and the funds went below $1. Rather than changing behavior, they just changed the rules of that behavior to lock you in. And they're going to do the same thing. The Fed and globally central banks are buying all this debt, even though they've announced that they're going to buy a little bit less, but they have to do it to attempt to control interest rates. The Bank of Australia gave up yield curve control because the traders overwhelmed them. And I think that that's what's going to happen for all of the central banks. And this is why the Fed is telling them, we can't raise the rates now. We cannot do it because the markets cannot tolerate increased interest rates. There's just too much debt. And the reason why gold has been a proven inflation hedge over 6,000 years is because there's the broadest base of buyer. So you always have demand, sometimes less, sometimes more. But this is what they revalue or reset the currency against. I know this was a lot, but we do not have good financial stability here or globally. You will own nothing and be happy. Everybody owns, or somebody owns, everything. Anything that's physical, somebody owns. Better you be the owner than Wall Street. It is time to cover all of your assets. We do that with the Wealth Shield. The foundation is gold and silver, but you need everything: food, water, energy, security, community, shelter, as well as barterability and wealth preservation.